Okay, so good afternoon, everyone. You're welcome to another class. So today we are going to round up on unconsolidated statement of profit or loss. Last week, we typically looked at associates, accounting for associate investments as governed by IS 28. And we learned there that when an entity has holding equity interests in another entity, and its holding is between 20% but less than 50%, it has an associate and it has significant influence over that entity. Our focus was, how do you account for such an investment? We looked at in the separate account of the parents, as well as in the consolidated financial statement. We learned that in the separate account of the parent, it will recognize that investment at cost or at fair value. And that is what it does. That is all it does. Additionally, in the separate account, particularly the statement of profit or loss of the parent, it will also recognize any dividend received from the associate as an income in a separate account. Therefore, in a consolidated account, which is in a consolidated statement of financial position for associate, for the parents, the parents will recognize the investment in associate at carrying amount. And this carrying amount is determined by having the cost of investment. You will add your share in the post-acquisition profits of the associate. If there's any dividend received, you remove it. That's what you're going to recognize in your books as the value of your investment in the associate in the consolidated account. Additionally, if there is any impairment losses, you also remove that from this investment. Also, in the consolidated statement of profit or loss, you will also recognize your share of the post-acquisition profit for the year, for that year of the associate, just for that current year. We also learned that if there are intra-group trading or intra-group transactions between the parent and the subsidiary, we said all income and expenses are cancelled out, just like we would do for investment in subsidiary, cancel them out. But assets or liabilities are not cancelled out in the statement of financial position. They are not. So when you make profits from your associate, such profits are also eliminated, of course, to the extent that the goods remain within inventory first. And also, you eliminate the unrealized profits to the extent of your holding in the associate. And we made a distinction between when you sold or when you sell to the associate, wherein you are the one that is making profits. Such profits can easily be eliminated from your retained earnings. But since the inventory is with the associates and we don't consolidate the account of the associate, the other leg for that elimination of unrealized profits will eat the investment in associates because that one is in your books, is in the consolidated account. However, if it were the associate that sold to the parent, the resulting unrealized profits would be eliminated from the retained earnings of the associates and the inventory of the parent. That was all we did, and we solved questions. The final part, not really the final part, because I'm still going to teach you group cash flow. Is consolidated statement of profit or loss. I want to go deeper into this. See, the principle of consolidation hasn't changed from what you learned for statement of financial position, because all we are doing is cancellation. Any transactions between the members of the group will usually cancel it out. If that transaction gives rise to a profit, we would cancel it out as well. So any income and expenses in their individual books that are the same, they are from the same transaction, we cancel them out. And that's all we want to do here. And I will also use this opportunity to teach you consolidated statement of changes in equity and see how that also works out. I will use questions to explain the principles. Let's look at a simple consolidation with no adjustment at all. It says PICO acquired 75% of the ordinary shares of ESCO on its incorporation in 2015. The summarized statement of profit or loss and movement on retained earnings of the two companies for the year ended 31st December 2017 are set out below. We're given the statement of P parent co and ESCO. We're also given movement on retained earnings. This is like an extract of equity. We're given the retained earnings at the beginning for the parent and for the subsidiary. We're also given the profit for the year for the parent and the subsidiary. And they sum them together. We are now required to prepare consolidated statement of profit or loss and extracts from the statement of changes in equity showing retained earnings and non-controlling interest. So all we need to do here is for us to sum together these items. That's all we need to do. We just need to sum them together and we are done. That's consolidation. Because in this case, in this question, we do not have any intragroup transactions. That's exactly what I did. In my statement of profit or loss, for the sales, I had together the sales of the parent and the subsidiary, which is 37,500 plus 19,000. That gives me this 56,500. I did the same thing for the cost of sales, 15,000 plus 10,000. That gives me 25,000. Then I got my gross profit. I did the same thing for admin. I got my PBT. I did the same thing for income tax. Then I got my profit for the year. Now, when you have done all that till profit for the year, then you need to share this profits because this is the group profit. You have to share this profit between or among the owners of the owners of the subsidiary, which are us, the parents, and the non-controlling interest. You must always share it. You must always do that. Your refusal to do it would cost you around 2 marks or thereabout, depending on the adjustments in the question. It could be more, it could be 4 marks at times. So let's share this 14,500, which is a group profit. So to share it, the tradition is to say, we'll do profit attributable to owners of parents, which is us, the parents, and the non-controlling interests. Usually, we are going to get the profit attributable to owners of parents as the balancing figure. You will always get it as the balancing figure. For the NCI, because we acquired 75% of the subsidiary, which makes the NCI have 25%. NCI will take 25% of the profit of the subsidiary, of the profit for the year. Let me be very specific. Of the profit for the year of the subsidiary, because this is P&L for the year. Don't make the mistake to go and apply the NCI holding on the group profits. Nope, not on the group profits. NCI does not have a share in our own profit because this 14.5 is group profit of the parent and the subsidiary. So out of this 14.5, how much is the profit of the subsidiary? How much? You go back to your correction. You would find it there. 4,000. That's the profit of the subsidiary. 4,000. So the parent would take, the NCI would take 25% of that. And that's 1,000. So it's taking 1,000 out of the group profit of 14,500, which I put here also as the total. When I take away 1,000 from 14.5, it gives me a balancing figure of 13,500. And that's the profit attributable to owners of parent. And that is it. The question did not stop there. He also wanted us to do an extract of statement of changes in equity, showing retained earnings and NCI. Now, the only items of changes in equity we have here is retained earnings. So I was given retained earnings brought forward, profit for the year and retained earnings carried forward. Now, what I need to prepare, what they want me to prepare is the consolidated statement of changes in equity. So to do that, I set a ground ruling for my consolidated statement of changes in equity for the year ended 31st December 2017. They want me to do that of retained earnings and NCI, then total. I start with balance brought forward. What I need here, what you need to put here is the retained earnings of the parent and that of the subsidiary. But you know that what we need to have here is the consolidated retained earnings brought forward. And this consolidated retained earnings brought forward will be the retained earnings of the parent and our share of the retained earnings of the subsidiary. We cannot put everything. We can only take our share of it being a parent. So the retained earnings of the parent is for the 43,500. Then we take our share of the retained earnings brought forward of the subsidiary, which I worked out here anyways. So the consolidated retained earnings brought forward is the retained earnings of the parent plus our share in the retained earnings of the subsidiary. If I add them together, it gives us 49,875. Then NCI will take the balance, which is 25% of the retained earnings of the subsidiary, which gives us 2,125. That's what I have here. 49,875, 2,125. So if I sum the two together, it gives me 52,000. What increases my retained earnings is the profit for the year, which I will get from my consolidated statement of profit or loss. The group profit for the year, that relating to the parent, is 13,500. While that of the NCI is 1,000. That is what I have here. 13,500 and 1,000. If I add them together, it gives me 14,500. And I can sum all the columns together. 49,875 plus 13,500. That's 63,375. NCI 2,125 plus 1,000. 3,125. Then total, this plus 14,500, 66,500. Okay. So that's the end of this question. Any questions, please? Fashion, I can see your hand.
Sir, sorry, when we were explaining how you got the 2,125, my network was misbehaving, so I didn't really hear you.
Okay. The 2,125 is just the NCI's share in the retained earnings of the subsidiary. NCI's share in the opening retained earnings of the subsidiary, which is 25% of 8,500. That's what gives us this 2,125, because the parent has taken their own share, which they added to their retained earnings, and that's how we got this, which is the retained earnings of the parent and that of the subsidiary. And this is the share of that of the NCI, 2,125.
Thank you, sir.
You're welcome. Yetunde, I can see your hand.
Good afternoon, sir. The part that you were saying is not the 14,500 you removed, that you got the 1,000. I'm a bit confused there. Yeah, this part. No, this her profit attributable to.
Yes, so what we did was to share the group profits. You must always share these group profits between the owners of the subsidiary, which are the parents and NCI. So you're going to get that of the parent as balancing figure, and that of the non-controlling interest. He will only do his own interest, his own holding in the subsidiary on the profit of the subsidiary. Don't make the mistake to go and apply it on the group profits. So, because this group profit also includes profit of the parent. So, where you get this 4,000 is usually the correction. It will give you profit for the year of the subsidiary. It's usually in the correction. That's where you will get it from. So when you get that, you just apply 25% on the profit of the subsidiary. That gives us 1,000. Okay. So we are now saying out of this 14,500, the NCI got 1,000. The balance is 13,500, which is that of the parent. So of course, when you sum the two together, it still comes to the 14,500. Understood?
Yes, thank you, sir.
Yeah. Any other questions before I move to the second question? Okay.
Hello, sir.
Yeah, Moses.
Sorry, in a situation where you are asked to consolidate profit or loss account of the group and the subsidiary, and the acquiring percentage is not given, is there any data we can use from the statement of comprehensive income to determine the percentage acquired by the parent company?
No, there's no data that you can use. They will give you the number of shares acquired. They will give you as an additional information, not in P&L.
All right. Thank you, sir.
Yeah. Okay. The second question. It says that PICO acquired 75% of the ordinary shares of ESCO on its incorporation in 2015. ESCO sold goods to PICO at 2,500 during 2017, which cost ESCO 1,500 to purchase from an outside supplier. Half of the goods remained in PICO's inventory at 31st December 2017. The summarized statement of profit or loss and movement in retained earnings of the two companies for the year ending 31st 2017 are set out below. Required. Prepare consolidated statement of profits or loss. So here, there is an adjustment here. There is an adjustment here that involves ESCO selling goods to PICO of 2,500. So the major thing is that ESCO will have recognized these 2,500 as sales, while PICO would have also recognized these 2,500 as purchases in its cost of sales. We have to remove them. We need to remove them. Additionally, the goods that ESCO sold at 2,500 actually cost him 1,500. It actually costs ESCO 1,500. So by implication, ESCO has made a profit of 1,000. And that profit is an intra-group profit that should also be eliminated, but to the extent of that the goods remain in inventory. And since only half of the goods remain in inventory, that means we are going to eliminate just half of the profits. we are going to eliminate just half of the profit. And that's all we need to do here. That's all we need to do here. So let's consolidate. I did some explanation of what I've just said here. So first is that the sales, to prepare my consolidated statement of profit or loss, the sales of the parent and that of the subsidiary, these two, 37.5 plus 19,000, that gave us 56.5. We are going to remove, we would remove the intragroup sales. We will remove it. Then the cost of sales, the addition of these two is 25,000. Since Pico would have included that 25 as its purchases, we would also need to remove it also. So there too, we'll do 25,000 minus 25. We'll do 25,000 minus what? 25. Now, I'm adding 500. You see, this 500 is what I worked here as unrealized profit. You know, I told you that the subsidiary has made a profit of 1,000. Okay? But we are only going to eliminate to the extent of that the goods remained in inventory. And since we were told that half of the goods remained in inventory, then we are only going to eliminate half of it. So we are eliminating 500. But how do we eliminate it? We cannot go and be removing from gross profit. Gross profit is like the resulting figure. So in order to make our calculations easy, we always add it to cost of sales. It's the same thing as removing it from profit, from gross profit. Just add it, just increase your cost with it. It will automatically reduce your profits. Just increase your cost with it. It will automatically reduce your profit. And we will always add these unrealized profits to 500. Okay? Who can tell me, where is the other leg of this? Where is the corresponding credit of this?
Inventory.
Inventory, correct. And since we are not preparing statement of financial position here, so there is no need. And it's because when we are doing statement of financial position, we believe that this is the correct place to eliminate the profit. But since they might not have, they wouldn't have adjusted. They wouldn't have adjusted it. That's why we'll usually adjust it from retained earnings, because this profit is usually transferred to retained earnings. And since, the profit of whoever is making that unrealized profit will have been transferred to retained earnings as well. And since it's a group adjustment, so we'll need to impact it there as well as even impacting it here also. So let's focus on this. So we usually add it, and that's all for this correction. So we get our group profit, our gross profit. Our administrative expense, we add the parent and the subsidiary together. Our income tax, we add the parent and the subsidiary together. And that gives us profit for the year, which is the group profit for the year. Now that we have the group profit for the year, then we can share it between the parents and the NCI. We can share it between the parent and the NCI. The parents will get it as the balancing figure while the NCI is what you get first. Again, since we have 75% holding, it shows that the NCI will have 25%. So we just do 25%, not on the group profit, but on the profit of the subsidiary. He only has a share in that. And the profit of the subsidiary, you get it from the correction, which is this. So when you do 25% of 4,000, but wait, this profit of the subsidiary, because he made an unrealized profit, which we have eliminated. Okay. And since we are picking this one raw data from his account that we have not adjusted, so we need to manually adjust that 500 unrealized profits. So we need to remove it because it was the subsidiary that sold. It was the one that made the profits. That profit that was unrealized was eliminated from its books. We need to remove this. You know that if it was the parent that sold, it would have been the parent that would have made the profit. We wouldn't need to do this adjustment. But it's the subsidiary that made the profit. It's the subsidiary that sold. So you will need to remove this. A lot of students usually forget this adjustment. At this level, they will forget. So you need to give it some level of thinking and understanding so that you won't forget. Otherwise, you lose some very key points. So whatever it is that is the balance, which is 3.5, take 25% of that. And that gives us the value of the non-controlling interest. Then the balancing figure, which is this, you take it away from the group profit, and that belongs to the parent, which of course will still add up to the group profit. And that's how you eliminate unrealized profits and intra-group sales between members of the group. Between members of the group. Now, let's look at the next one. This one says Pico acquired 75% of the 50,000 ordinary shares of ESCO on 1st April. Okay, please ask a question before I proceed.
Okay, sir, sorry. Please, why do we have to still remove the 500 naira from the NCI of the subsidiary?
500 naira. Okay, I will just see what I said again and see whether you understand it that way. What I said is that this 4,000, which is the profit of the subsidiary, includes an unrealized profit, as we saw from the notes that they gave us, that he made a profit of 1,000 and 500 of it is unrealized. That is included here. Okay, so we have to remove that because it has been eliminated. So we need to, and since we are picking this 4,000 raw from here, from the face of the account that we have not adjusted, so we need to manually remove it. We need to manually, because this 14,000 that we are sharing does not include that profit. It has been eliminated. It does not include that profit. This 14,000 excludes that profit. So that's why we are manually removing. It has been removed ordinarily from this group profit. So we just have to manually remove it. Since we have to go and take this profit from the account of the subsidiary, then we have to remove this 500 away. It's unrealized. It has been eliminated. Let me put it that way.
Sir, can you repeat it?
Yeah. So again, I said that the 500 naira, okay, we have to, it has been eliminated anyways. And don't forget that the profit we are sharing is this 14,000. And we have already eliminated on the unrealized profit of 500. But in determining the share of the NCI of these profits, we cannot just do 25% of 14,000. No, that's wrong. NCI cannot take a share of the parent's profits. It cannot. He's not an owner of the parent. He's an owner of the subsidiary, a part owner. So which is why we have to go back to the question to pick these profits. And these profits include unrealized profit that we have eliminated. We have eliminated, it has been eliminated. Take it like that. That it has been eliminated from the group. In determining the group profits, we have already removed it. So since we are picking this figure raw, okay, we need to manually remove it. So, and that's what we did. So please ask questions, make sure you understand it, because as far as P&L is concerned, it's only this part that is always difficult for students to get at the end of the day, because by the time we have plenty of adjustments, you'll find out that we usually manually calculate this one, because we always pick this profit from the correction. So all the adjustments we have made, we need to adjust them at this level too, so that we can update this profit with all the items that has been removed or added to it. So you need to understand the logic at this level that we only have one item. So you can ask me to repeat myself. I would happily do that. Another question, please. Just keep the questions coming. Just go ahead and ask.
To my best knowledge, the first part we added the 500 to eliminate it. So now this place we are minusing it.
Okay, good.
That's something I don't really, because this one is plus, that one is minus.
Okay, good. Okay. You know that this unrealized profit, ordinarily, we should take it out from this gross profit. It should be taken out from it. But you see, gross profit is usually a resulting figure, is a derived figure, is sales minus cost of sales. So we cannot get cost of sales, gross profit, and now say we want to deduct 500. So what we usually do is to impact it in cost of sales. Okay, that unrealized profit, we'll find a way to infuse it into cost of sales, so that it can have the same impact as reducing it from gross profit. So the only way to do that is to add it to cost of sales, to increase your cost with what you want to remove from your profit. You know, when you want to reduce your profit, just increase the costs. When you want to reduce your profit, increase the costs. It will reduce your profit. So by adding this 500 to this cost of sales, it has the impact of reducing our profit by the same 500. So we have achieved our aim of eliminating that 500 naira from the profit. Alternatively, you can say that you want to remove it from sales. You can say you want to remove it from sales, but you cannot dare do that because of IFRS 15. You cannot do that. IFRS 15 is very serious when it comes to sales is not something you joke around with. Your sales is your sales. But cost, you can play around with cost. That's why we are able to remove that profit by loading it into costs. I hope that makes sense to you, Shidima. Or Yetunde.
Yes, perfect. Thank you.
Okay.
Good afternoon, sir.
Hi.
Okay, sir. So the 500 naira we have on that part of the NCI, right? It is because the NCI is the seller, right?
NCI, no, subsidiary.
Sorry, the subsidiary is the seller.
Yes.
Okay. So
Yes.
if they were not, if the subsidiary was not the seller, we will not treat the 500 naira at all in that part.
That's correct. We will not treat it at all because it's not the subsidiary that will have made the profit. we wouldn't have eliminated the profit from 4,000. It will have been eliminated from the parent's profit. So that adjustment will not be necessary. That's correct.
Okay, sir, you mean that 4,000, if subsidiary were not the one that sold it, it would have removed it from the parent money, right?
Yes. So we won't need to make that adjustment here at all. We won't need to make that adjustment here. We just apply this 25% on the 4,000 straight on because we are not eliminating the profit from here.
All right.
Yeah.
But sorry, sir. The point is that now, if you are not removed, are we not going to show the workings at all? Or we are just assume that they have removed it before they said the question to us? From the parent, I'm talking about the parent retained earnings.
Parent retained earnings. Are you talking about this one?
Yes, sir. I'm talking about this unrealized profits. Are we just going to assume that it has been removed, or we are going to do the workings too, the same way we did for subsidiary?
We don't need to do any further workings again because this one was derived as balancing figure. And don't forget, the unrealized profit has already been removed before deriving this profit, which is what we are sharing between the parent and NCI. So we have gotten the NCI portion. The balance is that of the parent. So we don't need to go ahead to do any further adjustment to that again because it's already been adjusted here.
Okay, sir. So
Yeah.
I noticed something else too. I noticed that we don't have goodwill in this question. Is it that the question doesn't require us to calculate goodwill at all?
I need another student to answer that. Let me see. Who can answer this?
Now let me try.
Can I try? Okay.
Okay, so why we are not treating goodwill in this part is because this is not statement of financial position. You will only be treating goodwill if you are asked in the question, or probably you are treating statement of financial position.
Absolutely. Lekon, is that clear?
Yes, sir. Thank you, sir.
Okay. I need further questions, please. Ask question on this 500 very well. Make sure you understand it very well. Otherwise, know why we are removing it from here. No, I mean, ask whatever level of question you need to ask. Okay. Any other questions?
Sir, I wanted to ask for clarification as to because I understand what that the order balance of the 500, as we've removed it from cost of sales, we've removed it from inventory.
Yeah.
My own is like that's what I know,
Yeah.
not the why. That I don't know why.
Say it again. Can you repeat yourself, Ashito?
The 500,
Yeah.
the credit balance, we'll remove it, like we said, we would add it to the cost of sales then we'll now remove it from our inventory.
Yes.
So I wanted to ask for why. Why are we removing 500 from our inventory? Because the subsidiary sold something at value. Why not just remove that value and not remove it's like, why not remove the value at which we sold it? Why are we only removing the profits at which we sold it?
Okay, good. Okay, yeah. So two things, right? Number one is this: when the subsidiary sold, right? What happens is the subsidiary recognize sales, the counterparty, which is the parent, recognize purchases. You eliminate that expense and income, like we did here. Remove from sales, remove from purchases. So that is done because those are recognized in P&L. Additionally, whatever profit that is made, remove it. Remove it from the group profit. In this case, the subsidiary made 1,000 naira profit, whatever it is, And that profit, we said that we eliminate it to the extent that it's remain in inventory. And remaining in inventory means that it is still within the group. That profit, we have not really made it. It's not an economic profit. We are making profit within ourselves. No, we need profit made from outsiders. So we need to remove that. And see, adjustment in accounting is usually double legs. So where is that profit sitting down? It's sitting down in two places. Number one, it's sitting down in the profit, specifically the gross profit of the seller, which is the subsidiary, and also in the inventory of the buyer, which is the parent, in the statement of financial position. So we remove it from the gross profit of the subsidiary by adding it to cost of sales. We also remove it from the inventory of the parents. And don't forget, IAS 2 supports that. IAS 2 says that inventory are measured at the lower of cost and net realizable value. In this case, we are saying the cost is lower. Don't factor in the profit loading. Remove it. So we remove that profit load also from inventory, as we have done when we're doing statement of financial position. That cannot be done here because it's just P&L. Unless the question also wants you to do statement of financial position in addition to that. So that is the why. That's the reason why we need to remove it from inventory. The double entry has to be complete. Yeah.
Thank you, sir.
You're welcome. Okay, if you're not asking questions again, can you put your hands down? David, Yetunde.
I was asking now that what if it is not in inventory? How would you treat it?
That means you won't need to eliminate it again. It has been earned by the group. When you know that not in inventory means that they have sold it out. They have sold it out, which means that that profit has been actually made from another person outside of the group. So there is no need to eliminate the profit, but you are still going to eliminate the income and expense. That transaction between the two of them, you will still remove it. It's the profit you will not need to remove anymore. So I want to assume that every one of you understands this very well. You are going to get to the complex part today. So another one, it says Pico acquired 75% of the 50,000 ordinary shares of ESCO on 1st April 2017. The summarized statement of profit or loss for the year ended 31st December 2017 are set out below. So we're given the statement of profit or loss of the parents and the subsidiary. We have said you are required to prepare the consolidated statement of profit or loss and extract of the statement of changes in equity to include the retained earnings and non-controlling interest. Okay, so here, what is different here? Two things. Number one, we acquired the subsidiary during the year. We acquired him in April. When we acquired the subsidiary in April, it means that when you want to consolidate, we cannot just say this plus this anymore. We have to do a proportional consolidation. So it means that we were only with the subsidiary just for 9 months this year. So on each of these items here, you're only going to consolidate 9/12 of this. Okay, you're only going to consolidate 9/12 of these 40,000. It's easier that way to do it on the surface. There's an alternative way which can become complex immediately as soon as when there are a lot of adjustments that will have gone into the line items. Another way is instead of doing 9/12 of each of these items, you can just do 9/12 of these. Then you can just do you do 3/12 of these and remove it, something like that. But do line by line, only consolidate 9 months. 9 months of the items of the subsidiary. You will see it very soon. Secondly, we saw that we received dividend from the subsidiary. The subsidiary paid us dividend. And from this extract of equity, I can see that it actually paid its owners 3,000 dividend. So the way this 2,250 was determined is just 75% of that. And I need not tell you that this needs to be eliminated. We are going to eliminate it. Okay, we are going to eliminate it. So whatever is remaining, which is, I think, is 750. Okay, so who would that belong to? The remaining 750. Who can tell me?
The answer, sir.
Thank you very much, Lekon. That belongs to NCI. Fine. And those are the new things that I can see here. So let's get to work immediately. So again, for the consolidated statement of profit or loss, my sales, that of the parents, I will do 9/12 of the subsidiary. I get this. For cost of sales, that of the parents, I will do 9/12 of the subsidiary. I get this. Then I get my gross profit. I'll do the same thing for admin, that of the parents, 9/12 of the subsidiary. That's 26. Then I get my PBT. Then my income tax, parents, 9/12 of the subsidiary. I get 14.5. Then I get my group profit for the year. I get my group profit for the year. This group profit for the year, again, you need to share it between the parent and the non-controlling interest. You will do that of the NCI first. So NCI has 25% of the profit of the subsidiary, but we only take 9 months, just 9 months. So we do 9/12 of this 12,000, which is the profit of the subsidiary. Yeah, because there was no adjustment, so we just move on. It gives us 2,250. Okay. If you take that away from this group profit, whatever that is the balance is the profit attributable to the parent. So it all still sums together to 28,500. Now, the consolidated statement of changes in equity. They said we should do a column for retained earnings and NCI. So we have the total. First is the balance brought forward. Now, let me go to the extract of the retained earnings given to us. The retained earnings brought forward for the parent is 45. For the subsidiary is 20,500. In the last question that we did, what I did for this consolidated retained earnings brought forward is I took that of the parent and our share of the retained earnings of the subsidiary. In this case, you will all agree with me that we cannot do that here because this retained earnings of the subsidiary is a pre-acquisition retained earnings because we acquired the subsidiary after that date, which is in April. And this retained earnings is as at 1st of January 2017 or 31st December 2016. It is a pre-acquisition retained earnings. We don't have a share there. So the only one we can have is our own retained earnings, which I will take to my consolidated retained earnings, and that's that 40,500, which I extend it here. I'll come back to this value of NCI. Come back to that. Let me sort my profit for the year. My profit for the year is just as determined in my consolidated statement of profit or loss. That of the parent is 26,250. That of the subsidiary is 2,250. So 26,250, 2,250. Okay. Also, from the question, I was given dividend paid. The parent paid dividend to its own subsidiaries. Sorry, to its own owners, 6,000, which I will remove from whatever it is that is its profits. Then there is, out of this 3,000, the balance belongs to NCI. The balance belongs to NCI because the parent already got 2,250 out of it. So the remaining 750 belongs to NCI. Don't make the mistake to add it. That will be double counting. Dividend paid is even deducted and is already included in these profits already. It's taking his own share. So you remove this. So addition of the two gives 6,750. Now, why I'm taking this last value of NCI is because a lot of students will omit this. They will forget to do it. That's why I'm taking it. And you would always calculate value of NCI, usually when we just acquire the subsidiary that year. When you're just acquiring the subsidiary that year, you will need to get, okay, what's the value of my NCI? After that, you won't need to calculate it again because you just need to carry it forward and just be doing profit for the year. So this value of NCI is particularly relevant if you just acquire the subsidiary. So you need to know what's the value of my NCI. And this is exactly what we usually do, what we learned in statement of financial position. Okay. So here now, to get the value of my NCI, I have the share capital of the subsidiary and also the pre-acquisition retained earnings of the subsidiary. I will just take 25% of that. That is all I need. So the share capital of the subsidiary is 50,000. Then the retained earnings of the subsidiary, the pre-acquisition is 20,500. In addition to this 20,500, is there any other pre-acquisition profits? Yes, there is. Because this 12,000 profit for the year, 3 months of it is a pre-acquisition. 3 months, because we only acquired the subsidiary in April. So the profit of January to March is a pre-acquisition profit. So we need to do 3/12 of this 12,000, which is 3,000. That will be added to this 25. Okay, I did the workings for you. So I did share capital, 50,000. Pre-acquisition retained earnings, the retained earnings brought forward of the subsidiary plus 3/12 of 12,000. So that gave me 53,500. So I get net asset acquired. This is net asset acquired. So using proportionate share, I did 25% of that, which gave me 18,375. And that is the value of NCI. You agree with me that this is exactly the same thing we do in statements of financial position to get the value of NCI. So, and see, this very amount is just the same because this statement of changes in equity is going to SOFP. So we are pretty much doing the same thing. All right. So this brings us to 19875. 19875. And that's the end of this question. Any confusions?
Sorry, please, that NCI value of 18375
Mm-hmm.
is it from their share of share capital?
Yes.
Okay. Sorry. Doing it family.
Hello, sir. Please, how did you know that the share price is, the share capital is 50,000? You did give us nominal value.
I don't need to. I don't need to. I will just assume that that's what it is. If I don't have it, since they gave me, they gave me 50,000 ordinary shares, and they didn't give me 1 naira each. Just assume it's 1 naira each.
Okay, sir, my second question, the pre-acquisition retained earning that we're taking 25% for NCI, is 25%, didn't it arise as at April? Why are we taking it before April?
Well, so the
5% even
pre-acquisition,
pre-acquisition.
yeah, so the pre-acquisition retained earnings of 23.5 is as at April. It's cumulatively as at April. This 50,000 is as at April too. So we are just saying, okay, this is the value of the subsidiary as at April. This is the value of the subsidiary. So, and NCI has 25% of that value. So that's exactly what we want. Is retain earnings till the date of acquisition. Then we have 25, we acquire 25% of that. That's the logic. And I'm waiting for questions. Yes, please go ahead.
And sir, I'm asking about dividend pay of 2,250 naira for the parent company. How did you treat it?
I didn't consolidate it. I just ignored it because it has been eliminated. Because I can't consolidate it. That's why you won't find it in the consolidated account. You ignore it. It's an intra-group transaction that you don't consolidate.
Okay.
Yeah.
All right. Thank you.
So, which is why it actually canceled out with this 3,000 here. This 3,000, this is where they paid it. This is the payment of dividend. This is the receipt. So they cancel that one another. The balance of 750 is the only thing we have here. That's the only one we have here. So that 3,000 has been eliminated. The 2,250 has been
All right.
eliminated from there. Yeah.
Sorry, sir. I still don't get that 20,500 that we took in full and then now took 25% of it. Because I'm thinking the 20,500 earnings of
This
yes,
one.
that one. Yes, that one. No, we're taking it in full plus 3/12 of the profits for the year. But this 20,500, like, why are we taking 25% of it? How did we know that as at as at that date, 31st December 2016, we had 25% belonging to NCI?
We don't know. What we know is as at April. And like David asked, what we need is the value of the subsidiary as at April. So whatever it is that is the retained earnings as at April of the subsidiary is what we need. And it's 23,500. So which is 25 plus this. Whatever it is, all the retained earnings the guy has made from inception till the date of acquisition. That's the pre now. You have forgotten, you can't link what we did in SOFP with this. It's the same thing. This is just the pre-acquisition as at the date of acquisition. We usually eliminate it. And that was, it's eliminated against when you're doing goodwill. And it's what we usually use as the basis for calculating NCI. Like we'll just do value of the holding of NCI times the net asset acquired. And that's this net asset acquired, 73.5. So we just did 25% of this to get this amount.
So
Okay,
how
thank you,
do
sir.
you know that it's going to be 25%? Is
Because
it like the remaining
they
of the
told us,
75% they own or what?
yes.
Okay.
Okay. Let's solve another one. It says on 1st July 2017, Pico acquired 30,000 ordinary shares of the 50,000 shares in ESCO. The summarized statement of profit or loss and other comprehensive income of both companies at 31st December 2017 are set out below. So we're given the two statements. Then additional information. They said at the date of acquisition, the fair values of ESCO's assets were equal to their carrying amounts, with the exception of a building, which had a fair value of 500,000 in excess of its carrying amounts. At the date of acquisition, the building had a remaining useful life of 10 years. Building depreciation is charged to admin expense. The building was revalued again at 31st December 2017, and its fair value had increased by an additional 500,000. Okay, let me read this again and explain it properly. So it says that at the date of acquisition, the fair value of ESCO's assets were equal to their carrying amounts, with the exception of a building, which had a fair value of 500,000 in excess of its carrying amounts. So this we have seen before, and this is a pre-acquisition reserve. So because at the date of acquisition, the fair value of ESCO's assets were equal, with the exception of a building that has a fair value in excess of its carrying amounts. I told you that this is a fair value reserve, and since it arrives at the date of acquisition, it is a pre-acquisition reserve that will be cancelled out on consolidation. It's a pre-acquisition reserve. Also, it says at the date of acquisition, the building had a remaining useful life of 10 years. Okay. So building depreciation is charged to admin. That therefore goes to show that, the way I usually treat this, if you remember, is that this 500, one leg is reserve, fair value reserve, but a pre-reserve. The other leg, you increase the carrying amount, right? Now, since that increase is just coming in, and they have not charged depreciation on it, all through the years. In this case, we have not charged depreciation on it since we acquired it just this year, just for 1 year. No, not for 1 year, during the year in July 2017. So we need to calculate the under depreciation. So which is 500 divided by 10. That gives me annual depreciation. So since this is just 6 months under depreciation, so you just prorate it by 6 months, you will see. Additionally, we're told that the building was revalued again at the end of the year, and its fair value had increased by 500,000 again. So that means there is that year alone, there was 2 revaluation, one at the beginning of the year, one at the end. So, and this is that 1 million that you're seeing here. That's that 1 million. Just that this 1 million, 500 of it is pre, the remaining 500 is post, because this one is a fair value surplus at the end of the year, right? So which is okay. That one we're going to consolidate it. You don't need to cancel it out, so it's fine. And we're not going to calculate depreciation on it because the value was gotten at the end of the year. It's at the end of the year. So we have not really charged any depreciation, right, on any new value. And that's how this is going to be resolved. The second one, sales from PICO to ESCO were 3 million during the post-acquisition period. All these goods are still in inventory. So here, there is an intra-group sales that we need to eliminate. So we're going to eliminate 3 million from sales, 3 million from cost of sales. It says PICO marks up sales by 20%. So that means there would be an unrealized profit that we need to eliminate by doing 20 over 120 times 3 million. Why I'm doing 20 over 120? Because this 20% is markup. This 3 million is selling price. We cannot apply 20% on 3 million directly. This 3 million is already at profit loading. So I need to do 20 over 120. That converts the markup to margin times 3 million. I get my unrealized profit that I would remove from my gross profits of the parent in this case by adding it to cost of sales, just like we did previously. Finally, it says, despite the property revaluation, PICO has concluded that goodwill in ESCO has been impaired by 250,000. So despite the property revaluation, there was an impairment of goodwill. So here we need to impair our goodwill. So if we are calculating goodwill, we impair it, we remove it from the goodwill, and the other leg will be expensed to P&L. You can add it to admin of the group. And finally, it says, is PICO's policy to value non-controlling interest at full fair value? So the implication of this is that, I mean, the impairment of goodwill here would be shared between the parent and the NCI. Since NCI is measured at fair value, like I taught you, it means you will also have a share of this impairment, a share of this loss. So really this loss will therefore be deducted from the expense, will be added to the expense of the subsidiary, like that, just so that NCI also will have a share of it. That's how we're going to treat that. And income and expenses are co-evenly throughout the year. So what this is telling you is this: since the subsidiary was acquired during the year, then you can prorate the line items that you need to consolidate. So you don't consolidate the full year. You are now required to prepare consolidated statement of profit or loss and other comprehensive income for the year ended 31st December 2017. Okay, I've already explained everything that needs to be done. So just for me to show you exactly what it is. So the first thing is I computed my holding in the subsidiary because we're not given. Okay. I think somebody asked this, is it Moses, that if you're not given the holding, how are we going to calculate it from P&L? I told him we cannot calculate it from P&L. They will always give you the number of shares. Okay, they will just give you the number of shares, which they did. Unfortunately, it's not here. So 30 over 50, because we acquired 30 out of 50,000 shares. So that brings us to 60%. So 60% in escrow. Secondly, we're told that the fair value adjustment at the date of acquisition is a pre-acquisition reserve and will be cancelled out on consolidation. However, we need to determine the additional depreciation as follows. So I told you that this 500 is a pre-acquisition reserve, and we need to determine additional depreciation or the depreciation they have not charged. Like I told you, 500 over 10 times 6 over 12, that gives us 25,000. And I also told you that the other 500 is a post-acquisition reserve that we don't need to cancel out. It's something available for sharing between the parent and NCI. Also, I told you that this 3 million will be cancelled out, and the unrealized profit will also be cancelled out by adding it to the cost of sales, and this is how we compute it, 500. So that's all really. At your level, all of you now, if you have been paying attention and revising, there is nothing difficult here. So let's determine our profit. Ordinarily in the exam, we'll work it out. You see, we'll solve a past question now to round it up. You see how we're going to really work these things out. So first, I got the sales of the parents. I took 6 over 12 of that of the subsidiary because we bought the subsidiary during the year. Okay. Then I removed the intragroup sales of 3,000. I removed the intragroup sales of 3,000. I did the same thing for cost of sales. Okay. Then I removed the intragroup sales of 3,000. And the unrealized profits that we got of 500, I added it back. Don't think unrealized profit is always 500 though. It's just a coincidence that the last unrealized profit too was 500. Could be any amount. So I added it back. So that gave me this. So I added the unrealized profit to cost of sales. So we have a gross profit of 9,000. Then the next item is my distribution costs from the question. So this is the parents, 6 over 12 of the subsidiary. I added the two together, gives me 1, 2. Then the administrative expenses, the parents, 6 over 12 of the subsidiary. Then don't forget our adjustments. Number 1, we need to adjust for the additional depreciation of 25. And the question specifically told us that building depreciation are charged to admin. So that's additional depreciation that we computed for that fair value surplus. We add it to cost of sales, to admin. Then there was an impairment loss on goodwill. We add it to admin. If you wish, you can put it as a separate line item, but usually we add it to admin. So that gives us this total. Then the finance costs, parents, 6 over 12 of the subsidiary, gives us 325. Then we have a total of 4,650. If you accumulate all those figures together, 9,000 minus this, minus this, minus this. Then income tax. My income tax is 700, the parent, plus 6 over 12 of the subsidiary. gives me 925. Then I get my profit for the year. I get my profit for the year. Then other comprehensive income. Other comprehensive income would have gain on property revaluation. So the gain on property revaluation, I only take 6/12 of the 500. And which 500? Remember, the 1,000 year of this subsidiary, I told you that it comprises of two revaluations, one done at the beginning of the year and another at the end of the year. The one at the beginning is cancelled out, is a pre-acquisition reserve. It will be cancelled out in computing goodwill. The second is a post that will be consolidated. But since we acquired the subsidiary in July, so that's why we're only taking 6/12 of it. That's why we are only taking just 6/12 of it, which is this gain on property revaluation. Then investment in equity instruments, which is 100, which is also under OCI, this one. So that one is under parent alone. That also consolidated. So by the time you add OCI items plus profit for the year, it gives me total comprehensive income. It gives me total comprehensive income. Then this total comprehensive income would have profit attributable to, we're going to share it. And the way we do this here, this is a new thing that you need to try to understand as well. So the way we share this group profits, there are two of them. Number one, there is the profit for the year. We are going to share this. Number two, we are going to share these ones as well. Okay, but we usually share the total as well, the total comprehensive income. So first, you have to share the profit before OCI first, because there are two different kinds of profit. Okay, so this one is the real one that people enjoy. This one, it includes unrealized elements. So this profit for the year attributable to owners of parents and NCI. Like I told you, you get NCI first because you get that of the parent as balancing figure. In this case, NCI has a 40% holding because the parent has acquired 60%. So the balancing figure is 40%, which is NCI. Not on this group profit. This is group profits. You apply it on the profit of the subsidiary, which is 19. This 19. This. Now, this 19, because we acquired the subsidiary during the year, we take only 6/12 of this post, so that we will be sharing those the post. Now, again, we are now back to those manual adjustments. This profits, we had already adjusted it for two items. Number one, the additional depreciation that we have removed from it, from the adjustments we did here, especially here, and also the impairment of goodwill. And the reason why we are removing this impairment from goodwill from the subsidiary's profit is because NCI is measured at fair value. When NCI is measured at fair value, he would also have a share of goodwill, making him have a share of the impairment loss. So for him to have a share of impairment loss, we will usually deduct that impairment from subsidiaries' profits so that both the parents and the NCI will suffer the impact of that loss. And that's why this is coming here. And don't forget, like I explained to you in our last question, that this adjustment here has already been made. As you can see, we had already considered it. Just that since we are picking this figure raw, unadjusted, we need to adjust those things that is expected to have been removed from the adjustments we did, like the additional depreciation is removed from the subsidiaries' profits, from this profit, because it's the asset of the subsidiary that was depreciated. This impairment loss is majorly because NCI is measured at fair value, and you will also have a share of that loss. And that's why this loss is being adjusted on the subsidiary's admin expense. It was added to admin expense of the subsidiary, which would depress the profit. You know that if NCI was measured at proportionate share, right, he's not going to have a share of the goodwill. He's not going to suffer any loss on goodwill. We won't have, therefore, need to adjust for this impairment loss because it will be added to the expense of the parent alone. But since it is measured at fair value, it needs to have a share of that loss. So when you take 40% of this amount minus this, it gives us 270. Now, out of this 3725, is taking 270. Balance is 3455. So if you sum them, it still gives you this 3725. That's that. We have shared this. Additionally, you're also going to share this total. This total. That's how it's done. So I did total comprehensive income attributable to owners of parents and NCI. In the same vein, you calculate NCI first. So you do 40%, not on the group total comprehensive income, but on his own total comprehensive income. The subsidiary zone, I mean, which is 29. So we did 29. I had to remove this 500, this pre-acquisition reserve that is included here. I removed that because it has been cancelled out. So I removed that 500. Then I took 6/12 of that because I acquired the subsidiary during the year. Then I need to also adjust for the same thing I've adjusted here. I need to adjust it again. Why? Because this 19 profits is inside here. Is inside this 29. This 19 is inside this 29. Okay, it's 19 plus 1,000. So I need to remove this adjustment. Just replicate the same thing. So it brings me to 370. So NCI gets 370 off the total. When you take it away from that, it gives us a balance of 3705, which will be the portion of the parent. Portion of the parent. So balancing figure 3705. So if you add the two together, it still gives you this 4075. And that's the end of this question. Any confusion?
Yes, sir.
Okay.
The non-controlling interest of the comprehensive income. You were saying you got 500 from somewhere and it's 29. I don't understand.
This 500 is the pre-acquisition retained earnings or reserve inside here. This 1,000, like I've explained to you, it comprises this 500 plus this 500. This one is pre, this is post. So pre is cancelled. Usually it has been cancelled out on consolidation. So that's why I had to remove this 500 first. Is that pre portion that I removed?
Yes, sir. Please, I have two questions. Number one question is this admin expense. Please, where did we get this 250? That's number one question. Then, if this 250,000, are we not supposed to, just like we did on the first question we solved, are we not supposed to remove unrealized profit from the NCI of the subsidiary?
Okay. So first question, this 250 is the impairment loss that they give us in note C. The goodwill was impaired. Okay. So you remove it from goodwill, you expense it. That's the two legs. So are the two legs. So it's an expense. That's why we're adding it to expense, impairment loss. That's one. Two, the unrealized profits was made by the parent. The parent made the profit, not the subsidiary. So we are not removing it from the profit of the subsidiary. So which is why we didn't have to adjust it here like we did in the previous question, because it wasn't removed from this profit. It was removed from the profit of the parent.
Thank you, sir. Thank you.
You're welcome. Okay. I was waiting open to get more questions. So let's even solve. Yeah, for your information, I'm actually done. So let's solve past questions.
Sir, I'm so sorry. The 25 that you were adding and omitting with the 250, how did you get that part?
That's the additional depreciation. That's the additional depreciation that we computed here.
Uh,
From the fair value surplus. So the value of the asset is supposed to be 500 more, which they have not included. So we included it and we'll charge depreciation on it. So this is the depreciation leg, 25.
okay, thank you.
Yep. Okay. So Olu Nigerian PLC has a subsidiary Oba Limited, which it acquired on January 1st, 2022. The financial statements of the companies are detailed below. I have statement of profit or loss for the year ended September 30th, 2020. So I was given the statement of profit or loss, and I'm also given the statement of financial position for the period. Okay. And when did we acquire the subsidiary? January 1st, 2022. I mean, that tells us something. What does it tell you? Anyone?
It's not up to a full year.
Correct. We acquired the subsidiary during the year. That being said, they gave us some additional information, plenty additional information. This is why you're going to have it in the exam anyways. Plenty. Number one, we're told that Olu acquired 70% interest in Oba through a share exchange of 3 shares in Olu for 5 shares in Oba. At the acquisition date, the shares of Olu were sold at 8 naira 10 kobo each at the Nigerian Stock Exchange. The parent company is yet to record this share issue in its books. Okay. So this one is telling us that Olu is the parent entity and he has 70% holding. And the way he paid for this 70% is not through cash, not through contingent consideration, but through shares. He issued shares to Oba. And how many shares did he issue? He issued 3 shares for every shares he has in Oba. You see how that's computed. It's just as stated, 3/5 times 70% of the total number of shares in Oba. So whatever you get multiplied by the value of his shares, because he's issuing his shares, he will issue it at his issue price. He will value it as his share price. So, and his share price is 8 naira 10 kobo. So that is the way that will be determined. Furthermore, note 2 states that at acquisition date, the fair value of Oba Limited's assets were equal to their carrying amount, except for an item of PPE, which has this thing is like every diet is always there. They like this additional information, die. That even if you are the one that has been following, without even thinking, you should know what is required. So this 30 million is pre, and there will be additional deposition you need to complete on it. It has always been like that. So they said this fair value has not been adjusted in the book, so we adjust it. The set plan has a remaining life of 5 years. Why they are telling us is just to do 30,000 over 5 years. All right. Since we acquired this guy in January and his year end is September, so we just do 9/12 of that to get the additional depreciation. Note 3 says during the year, Oba Limited transferred goods worth 40 million to Olu PLC. These goods were invoiced at cost plus 25%, and only a quarter of the goods had been sold by Olu at the end. All right, so these intra-group sales of goods will be eliminated. So we eliminate it from the sales and purchases of the parties. Additionally, we are also going to eliminate the unrealized profit. This is cost plus, so this 25% is a markup. So we do 25% times, no, 25 over 125, because we need to convert it to margin. We'll do 25 over 125 times 40 million. Whatever we get is the intra-group profit. What we eliminate is to the extent of the goods that is unsold. Since only 1/4 has been sold, so 3/4 of that profit is the unrealized profit, because that's the goods, that's the portion that is unsold. That's the portion that we will eliminate as unrealized profit. Note 4. Included in the other income was 6550 received from Oba Limited as interest paid on loan granted to Olu. The loan was fully repaid before September 30, 2022. This will be cancelled out. It's an intra-group transactions. So the interest income cancelled out against the interest expense. We'll eliminate them. Next, says an impairment test carried out revealed loss in value of goodwill at the acquisition date of 28 million. So again, this is an impairment loss that we're going to deduct from our goodwill and which we're going to expense. So where we're going to expense it to, is it going to be removed or added to the admin of the parent or of the subsidiary? Depends on how NCI is measured. If NCI is measured at proportionate share, it will be added to the admin expense of the parent. If NCI is measured at fair value, it will be added to the admin expense of the subsidiary, so that both the parent and NCI will have a share of that loss. Now, the reveal, note 6, it says the group policies to value NCI at fair value. So you will have a share of the impairment loss as well. We're told that the prevailing market price per ordinary share of Oba at January 1st, 2022 is 5 naira 5 kobo. So This will help us determine the value of the NCI. Okay, since they have given us the share price of the subsidiary, so we can use that to get value of NCI. We're given the gain on evaluation of property arose from an independent valuation of the group's property in September 2022. So, where is that? Okay, this one. This gain on property revaluation, is it for the two or one of them? Anyway, it's for the two. So the gain on property evaluation arose from an independent valuation of the group's property. So they did the revaluation, so they had this, right? They had that. Also, we're told that the administrative, for the record, it means that these are posts, their income, especially this of the subsidiary. It's not a pre-acquisition reserve, it's a post, right? This evaluation reserve is not a pre-acquisition reserve, is a post because it was measured at the end of the year, post-acquisition. So finally, the admin expense of OBA included 10 million paid as management fee to Olu PLC, and the income have been duly accounted for in the books. Okay, so this will be cancelled out on consolidation as well. To be cancelled out on consolidation. All right. So what again? Except where indicated, income and expense are equally over the period. Okay, that's noted. So they will always tell you this, where you acquire the subsidiary during the year, just so that you can conveniently do a proportionate consolidation like that. You won't consolidate the entire line items. Okay, so we are required to prepare the consolidated statement of profit or loss and other comprehensive income for Olu Group for the year ended September 30, 2022. We are also required to calculate the goodwill on acquisition and non-controlling interests at the reporting date. C, IFRS 10 on consolidated financial statement states that a parent must present consolidated financial statements in which it consolidates in investment in subsidiary. Required states 4 exceptions to the above pronouncement of IFRS 10. 20 marks. Okay. So let's deal with this systematically by clearing all this additional information. Nothing new here at all, just everything we have mentioned. So let me just walk you through. First one, we acquired 70% holding through share exchange. We are going to give the subsidiary shares for our holding. Is 3/5 of every shares we acquired. That's what they told us. So it gives 16/8. So mistake you can make in the exam is to not remember to do for every share we acquired in it. You will just go ahead and do 3/5 of 40,000, which is the total number of shares in the subsidiary. And how do I know that? This is it. This is the ordinary shares. This is over 40,000. So number of shares is 40,000 shares. So we are giving him 3 shares in Olu for every 5 in Oba. Okay? For every 5. We are giving you 3 of our shares for every 5 we acquired in you. So so it's 3. I'm giving you 3 for every 5 I acquire. So what I acquired in Oba is 70% of the total number of shares. Then 3/5 of that. Then I'm giving him 16,800 shares. I would measure that at my share price. When I say mine is the parent, they give us a share price at 8 naira. Let me show you. Yesterday, are you seeing it? Don't ask me where did I get this 8 naira again. This is the 8 naira. It was gotten, they gave us here. So 8 naira times 16.8. So that's 136. Is this supposed to be 080? Can you please confirm?
Yes, correct.
It's
It's
correct, sir.
correct. Okay. All right. So that's that. That's the first note. The second one is that fair value surplus that I told you is a pre-surplus. This one to be cancelled out of consolidation, and we need to calculate additional depreciation, which is the 30,000 divided by 5 years times 9/12, and that's 45. Okay, so we're going to add this to the admin expense of the subsidiary. We'll add this to the administrative expense of the subsidiary. That's that. Furthermore, note 3, intragroup sales. Okay. So intragroup sales of goods. So we sold goods for 40K. We remove it from sales and cost of sales on consolidation. And the unrealized profit. So the unsold inventory. No, let me not do it like this. Let's do it like this. What's the intragroup? Let me do the intragroup profits. I think this is not the way I taught you. Taught you this way. The intragroup profits is 25 over 125 times 40,000. How much will this give us? Anyone?
1,000.
Again, come again. I can't hear you.
8,000, sir.
8,000.
Okay. 8,000. Then the unrealized portion is the portion that is unsold. So 3 over 4 times 8,000. What would that give us? She should still give you that 6,000.
6,000.
Okay, 6,000. 6,000. So we're going to add this to cost of sales to eliminate it from the subsidiary's profits. Okay? We'll add it to cost of sales to eliminate it from the subsidiary's profit, since it's the subsidiary that sold. Then the next one was this intragroup interest and interest, which will be cancelled out, which I mentioned here. That this interest should be eliminated from the group interest income and finance cost. So we eliminate that. The next one was talking about goodwill. This would remove it from goodwill and add it to admin of the subsidiary. Because, which is, what's his name? Oba. And why are we adding it? Because, who can tell me why are we adding it to the expense of the subsidiary and not of the parent? These impairment loss.
Because it's
Because
measured,
okay.
Lekon, continue.
because it is measured as
Lekon, we can't hear you.
I feel because it is a loss. I'm sorry, impairment. Yeah, loss or the goodwill is. What am I saying?
It's
It's a
because NCI is measured at
Because
fair
NCI
value.
is measured at fair value.
is
Yeah, thank you very much. Yeah, let me go back to Yetunde. Yetunde, what were you trying to say? I want you to say it.
I was trying to refer to the first one that we did, that the goodwill being an impairment has to be deducted from the figure. That's what I wanted to say.
I don't understand.
The previous question that we did, the goodwill being impairment, you deducted it. So I'm saying it's a loss.
Yes, now we deduct it,
That's what I
But
wanted.
yeah. So what I
Sorry.
want, what I was asking, Yetunde, what I was asking is that yes, we know that you don't deduct impairment loss from expense. It's an expense in itself. So you add it to admin. But you need to understand, are we adding it to the expense of the subsidiary of the or the parent? Okay. You're adding it to the expense of the parent if NCI is measured at proportionate share. It means that NCI will not have a share of that loss. So you add it to the expense of the parent. Let the parent bear the loss alone. But if NCI is measured at fair value, you add that impairment loss to the subsidiary so that the parent and the NCI can share the loss. Okay?
Yeah.
Okay. Now, the next one was management fee. So this we'll need to remove it from admin and other income of whoever was collecting and whoever was paying. We will see. Then let me even see the way they put it. Admin expense of OBA, okay, include 10 million paid as management fee. So you remove it from OBA's admin. And it was in the income of Olu. So you remove it from the income of Olu. That is all. That is everything. So before you go ahead and start preparing, it's simple, right? So before you go ahead and start preparing, you need to then, I don't want you to start making some major adjustment on the face of the account. So I started with the sales. Okay. The sales of Olu is 446. I won't be going back. I just wanted to show you just this one. So this is 446. Then that of Oba is this. But that of Oba, since we acquired him during the year, okay, so we'll prorate this by 9 months. January to September is 9 months. So you do 9/12 of that. So yeah, which is this. So 9/12 give us this. Then you remove the intragroup sales of 40,000 as shown in workings 2. So this is what will consolidate. Then cost of sales, that of Olu is in the question. We do 9/12 of the subsidiary, which brings us to this. You remove the unrealized, the intragroup sales, and you add the unrealized profit so that it will reduce the gross profit. So you add the unrealized profit to the cost of sales of, it doesn't really matter, but just for understanding, who sold? Let me see. Oba sold, okay? So of Oba, so Oba is the one that made a profit. Okay. So this is the group cost of sales. This is what we consolidate. Other income, and I'm just picking it line by line, just so you know. Line by line. I pick this, I pick this, pick this. So other income, this guy, oh look, 4250. Subsidiary doesn't have any other income. So you just remove the interest received, this 655550. So is intragroup, we eliminate it. And also the management fee collected, we eliminate it. So we only consolidate the balance. Admin, parent, 31,650. Subsidiary, we take 9/12 of that of subsidiary, brings us to this. Yeah, so impairment, that impairment of goodwill, we add it to, yeah, it's added as expense, but it's of the subsidiary. It doesn't really matter which is, but you need to understand that, okay, it's been added to that of the subsidiary because NCI is measured at fair value. Then the additional depreciation that we solved is also, that belongs to the subsidiary as well, because subsidiary's assets is added. The management fee, we take it out, intra-group, we took it out from income, take it out from expense. So we are left with this as group expense that we are going to consolidate. Finally, it's finance cost. Parent, 8,575, subsidiary, 9/12 of 72, brings us to this. The intra-group interest, we eliminated it, the income part, the expense part will be eliminated from here. So 6,550. So we have a balance of 7,425 that we are going to consolidate. And that is all. So I now did my NCI. I want to do workings for my NCI because it's more complex now. A lot of students would get this wrong. Because I saw that when I saw my first question, my second, it was at this level you guys were asking a lot of questions. This NCI. So, and this NCI I'm working here is the one I used to do. Let me show you. Is this one I used to do. I used to do profits attributable to, I used to do profit attributable to NCI. This one, they will adjust the profits and all that. So, because then here there are like more than up to 4 adjustments. So it's better to just work it out first. Better to work it out. So first, I got the subsidiaries profits since the NCI share of is always on the subsidiaries profit, not on the group profit. So I got subsidiaries profit. Where do I get it? From the question. It's 19,650. Okay. I took 9/12 of that because we acquired him in January. So 9/12 of this, it gives me this. Then all the adjustments I've made that has impacted the subsidiaries profits. Number one, goodwill. And that's because this was measured at, NCI was measured at NCI. Number two, unrealized profits. This because it was the subsidiary that made the profits. Number three, interest expense. This because it was the subsidiary that borrowed money. We eliminated it from the income of the parent. It was eliminated from the profit of the subsidiary. In deriving the profit of the subsidiary, let me put it that way. Then management fees as well. It was eliminated from the income of the parents. It was eliminated from the expense of the subsidiary also. So this is eliminated. And you would see that for the impairment of goodwill, I deducted it. I deducted it in the sense that it was deducted as an expense. This one was also deducted as an expense as well, unrealized profit. But all these ones that I'm canceling out, this interest expense is just a mere cancellation in the sense that this interest expense was deducted from the profit of in deriving the profit of the subsidiary. I'm saying, no, don't do that. Cancel it out. So I'm adding it back. It's like a reversal of what they had done to neutralize it. It's already deducted. Now I'm adding it back. So that's what I'm doing with these intra-group transactions here. So the same thing applies to this guy as well. So I'm reversing it. I am reversing it. Also, the additional depreciation is his own asset. So the depreciation will have impacted his expense, his profit. So I deducted it also. Now, this profit now, after all the adjustment, is now this 7212. So this is the adjusted profit. Now, having determined that, let me just, since he does not only get a share of the profit, he also get a share of the total comprehensive income, and it is that of the NCI he gets. So that's why I added this 5,000. Let me show you just from the question too. This one, this 5,000, yeah. That's the other comprehensive income. So I just added it to whatever we got here. So the total comprehensive income, even though it's a loss, right, is now this. Now, having set them already, I can now take a share of that. First, I'll take a share of the profits, and I will take a share of the total comprehensive income. So 30% of this is 2164. 30% of this is 663.6. So I've already made my life easy. I just need to plug in when I'm doing my profit attributable to NCI and total comprehensive income attributable to NCI. Since the question also required us to do goodwill, so I know I will need my pre-acquisition profit. And since I've acquired this subsidiary during the year, so I was given the retained earnings at the beginning from the question. Retained earnings brought forward. Where is it? This one. 550. Not brought forward though. This at the end of the period. Okay. This is 550. And where is it? So this is 550. Then I removed the profit for the year for 9 months, which is 9/12 times 19,650. So 9/12 of this. So give me 9-month profit. So that takes me back to the retained earnings as at the beginning of the year, as at January, which is the pre-acquisition retained earnings. So again, I need my pre-acquisition retained earnings, but I'm giving the retained earnings at the end of the year, as at the end, which is 15,550. So I took away the retained earnings, the profit for the year, the profit for the period, the post-acquisition profit, which is 9/12 of this. So if I take that away from this, it takes me back to profit as at the beginning, which is the pre-acquisition profit. So that gives me my pre-acquisition profit as there. So now what is left is just to plug in. I've done the hard work. So for my working 7, I can get my consolidated profit. For my working 8, I can get my consolidated cost of sales, which gives me my profits or my gross profit. For my workings 9, I could easily pick up my other income. Then I didn't work out this distribution cost. This is the parents, 9/12 of the subsidiary gives me this. Then for my workings 10, my admin, for my workings 11, my finance cost. I didn't work out this. This is the parents, 9/12 of the subsidiary gives us this. Then we have my group profit as 52,842. Then other comprehensive income. There I have gain on property revaluation. I add it together, 26 plus 5,000. Which gives me 31,600. So if I sum this together, I would get 84,442. So I can then share these profits. I get profit attributable to owners of parent and NCI. For NCI, I've already worked it out, so I don't need to sweat. So 2164 gives me this. Then this is the balancing figure, which is this 2164 minus this group profit. I get this balancing figure here. But since this was a loss, so by the time you 52 minus this gives you 52,000 plus that. So it brings it up to this. So it still cumulates back to this figure here. Then total comprehensive income attributable to owners of parent and NCI. So NCI is for my workings again. I pay it up from there. Then owners of parent gets the balancing figure. So since it's a loss also, so this 84,442, by the time you add it to this, it brings it up to 85,105. Then it still cumulates back to this. But there's something I need to bring your attention to. Looking at this 5,000, I saw that we did not do 9/12 of this because this 5,000 is that of the parents. I think that's a mistake from me. This 5,000, where is it? Yeah. This 5,000 is so the reason why I would not have done that, when was it valued? Okay, this is it. So the gain on property evaluation was done at the end of the year. So it's a reserve at the end of the year. So am I supposed to prorate that again? Since it was determined at the end of the year, and except where indicated, income and expense are co-equally over the period. So even though the income was gotten as at September, it's still an income. So it's still an income. Income is income. So we cannot therefore say we have a share of everything. It's income. So as far as that year is concerned, we should have just 9/12 of it because we acquired it in January. So its any element of its profits, we take 9/12. We can't take the whole. So yeah. So I need to update this. So can you give me the figure? What's 9/12 times 5,000?
3750.
Okay. Let me add it to 26,600.
30,350.
Okay. So let's add it to this group profits to get the total comprehensive.
83,192.
Okay. So yeah. 83,192. Let me do it 3,192 plus this 6 is 3.6.
$83,855.
83.
855.
There's no 0.6.
There's 0.6.
Okay. So it's still going to end up with 83,192. Still end up with 3,192. Okay. So I needed to correct that. Yeah, it was a mistake because in the last question, that we solved, this one, we took 6/12 of it. Where is it? This one. We took, yeah, so which is correct. And it was also measured at the end of the year as well. It was valued in December. So to be wrong, not to be consistent with that. Now, we're also required to calculate goodwill. So we already got the purchase consideration from workings one, value of NCI. So 30% of the number of shares of the subsidiary times the share price of the subsidiary gives us this. So if I add it together, it gives me 196,680. I cancel out against the net asset acquired. The share capital of the subsidiary is 40,000. Pre-acquisition retained earnings, we work that out in workings 13. Then the fair value reserve of 30,000. So my net asset acquired is this. So if I should net it off, I have a goodwill of 9868. There was an impairment loss of 28. So balance of my goodwill is this. Then my NCI, so value of NCI is this. I just usually pick it from here. Okay. So I wonder why you guys were getting confused when I was doing equity value and I was trying to get value of NCI and I got net asset acquired and you're asking, okay, how did I know this pre is an why are you guys asking all these ones again? Is whatever it is the pre as at that date we add to share capital. So value of NCI 6,600. We pick up this. Then it will get share of evaluation surplus, which is 30% of 5,000. 30% of 5,000 times 9/12. So how much is that? Let me correct this.
$1,125.
1,125. You will also get share of post-acquisition retained earnings of the subsidiary. In this case, it was a loss. And 30% of this is 2,164. And how did I know that? We already worked it out here. This 7,212. After making all relevant adjustments for us to derive this. So just this 30% of that to have a share of post-acquisition retained earnings. Then gives me 2,164. Then I accumulate all this, it brings it to 59,936. And that's the end of this question.
59,561.
59,561. Okay. So this is 2021. If you wish, I can remove the solution from it just so that you can try it yourself. Then I share the solution with you if you're able to try. Should we do it like that?
Yes, sir.
Yes,
All right,
sir.
good. Great, Yetunde. Okay, and I will also send additional question with you to practice All right. So technically that's the end of group accounts for skills students. But again, there was a day they asked you guys group cash flow. And for that reason, I'll be teaching you group cash flow. So that they won't surprise us, because I don't want surprises. I want to teach you everything that you need to know. So we're going to, in the evening by 9 p.m., we're going to be doing simple cash flow. We're going to do simple cash flow. I might finish it, I might not finish it. It doesn't really matter. Then next week, Sunday, I would finish up with the consolidated cash flow, both for you and for the SBL guys. So we're done with that. Then immediately I will teach you EPS. We have not done EPS. Then what is left is just very few. In the first or second week in April, we'll clean out things like leases and financial instruments as well. I think those are the key standards left. And if there are any other peripheral things, we would also touch it up. So I would update you guys separately as we move on. For now, enjoy your break while we meet by 9 p.m. Thank you. Bye.